Hello and welcome back to The Note. We're going to be discussing the Chinese currency today. China is already the world's second largest economy. Potentially, as it opens its currency, that could become a very important currency on the world stage. How exactly do we make money out of that? With me now to discuss this is the head of fixed income for Asia Pacific for AllianceBernstein, Hayden Briscoe. Hayden, thanks very much for joining me in London today.
Thank you.
Let's start by taking a look at the scale of the offshore renminbi market. This is really quite dramatic, the growth that's happening. What's driving it? What's happening?
Well, since 2008, when the imports and exports collapsed in China, I think China was just basically shocked that that could happen with one little bank in their perspective called Lehman Brothers could bring their trade to a standstill. So they've been proactively going around getting exporters and importers to start settling in renminbi. And that makes sense. They're happy to settle in any currency as long as they can convert it back to their home country. What you can see here is that China's big enough to matter.
Right.
So
exactly.
Exporters and importers are embracing it. I was in London 12 months ago. I was talking about 10% of their global trade is getting settled in renminbi. It's now 20. If I come back in another 12 months, I'm pretty sure it's going to be 40 or 50%.
Okay, so there's a growing trend. Let's take another look at this another way, which is through the letters of credit market, basically the way in which it's being used for trade finance. Obviously, the dollar is still a remarkably hegemonic currency, but what is happening here? How has it managed to grow to almost 9% of the market?
Well, this is even more fascinating. The euro's been around for a lot longer than the renminbi.
Yeah.
And you can see here that's 6.6%. China has already overtaken that, and it's not a freely convertible currency globally just yet. We only have the offshore renminbi. So exporters and importers, particularly on the commodity side of the equation, so those from Latin America, Australia, the Brazils of the world, are starting to embrace the currency because they have a need to continuing to grow their exports to China.
Okay, so there's an obvious growth in the use of this currency. What about the value of the currency? It's been an extremely deliberately managed currency until now. How can you go about assessing the forex risk if you want to use this?
So up until recently, the currency has been very stable relative to the US dollar, and that makes sense from a political perspective. You're trying to get exporters and importers to embrace the currency, so you want to see some stability. As far as the authorities are concerned right now, though, that has been a little bit too stable. They've started to introduce some volatility. So the currency is now allowed to move plus or minus 2% relative to the US dollar. So slowly enhancing that flexibility.
But we are seeing, you would think that it would be continuing to appreciate at the moment. They've got this big current account surplus that they want to deal with. That's not happening. We're actually seeing a return to a slight weakening so far this year. That's the kind of thing that can lose people money if they get on the wrong side of that trade. What's happened there?
Well, essentially what's happened is in the last 9 years we've been on this appreciation path, as you point out. But in the last 3 months, what they've noticed is there's been a big build-up of one-way traffic where the exporters have continued to believe that the currency was going to appreciate, and a lot of centres or financial centres have got involved in financial structured products. That's not a healthy development, and the PBOC are very forward-looking and have actively gone in to reverse the currency to ensure that people unwind those structured products and a bubble does not build up. So I think it's been a very positive development that the PBOC has depreciated.
Okay, now one final question. You're in charge of allocating bonds across jurisdictions. Potentially China is, whatever it is, the second biggest bond market on the planet. How do you go about allocating fixed income now to take account of what you think is going to happen in the future?
Well, I think it's fascinating. You've got over a $4 trillion market, and effectively the world has a zero allocation to that bond market. It's the second largest net creditor nation in the world. They have $4 trillion worth of foreign exchange reserves, so a lot of flexibility. So from a bottom-up perspective, China looks like a pretty good risk to me. And you've got the bond market effectively yielding around about 4%. So a big liquid bond market yielding 4% with maybe double or triple the yield of other bond markets around the world. And from this part of the world in Europe, out-yielding peripheral European bonds. So I think that's a very attractive asset, particularly when inflation is low and stable in China as well.
Okay, thank you very much indeed. You'll have heard a lot from us at the FT about the risks facing China. They're real. The opportunities are, it has to be said, real as well.